Well, thanks everybody for joining us. I know we have about a minute, so we'll just give it a minute. But we're excited to be at this panel today. Thanks. And actually, what is interesting, I will say while we're waiting for everybody to join us, when I talked to this group prepping for this about the K-12 M&A story that nobody's talking about, for this group of people was unbelievable because this is something that they live and breathe every day. So that's why we're pretty lucky to have this group with us today. Well, why don't we get started? Thanks everybody for joining us. The focus is going to be K-12 M&A, the untold story that nobody's talking about except this group here and a lot of us in this room. We're lucky to be joined by leaders across companies and one of the leading investors across K-12 in PowerSchool, Imagine Learning, Curriculum Associates, and Francisco Partners. We're going to cover a bunch of themes all related to M&A and K-12 throughout the day. One, the K-12 market environment, the regulatory environment, how AI is affecting M&A priorities, because we got to touch on AI sometime. M&A versus other liquidity options in what makes an acquisition successful, and if we have time, a lightning round from this group to where they're spending and focused on their M&A priorities for the next 12 months. But why don't we get started with the M&A environment and priorities? I was watching a panel from 2018 at ASU+GSV, and in it, they were talking about how M&A activity had continued to pick up, and were we at the peak of M&A activity in 2018? Obviously, we were not at the peak in 2018. It continued through 2021. But there was a slowdown post-2021. So my first question for the panel is, have we seen the peak of M&A activity? Where are we in the cycle? Are we in a bubble? I don't know, Jason, if you want to kick it off.
Sure. Well, we're definitely not in a bubble. I think of a bubble as being, speculation on asset prices devoid of like underlying fundamentals, and that is not the world we're in now. Actually, I don't even think it's the world we were in this market in 2020, 2021, and 2022. I think back then, what you just saw was basically extraordinary financial performance from many companies in this market, combined with like the accelerant of low interest rates and prolific fiscal policy, leading to like actually a pretty well-reasoned run-up in prices, and then a reversal of both of those things, except for the fiscal policy, which remains. And so therefore, like a reasonable downturn in asset prices. But where we sit today, it is, I think, a pretty constructive environment if you want to put capital to work, because there's rationality in the market. And if you're selling a business, it's not so bad either. So I think it's a pretty reasonable market today. I certainly wouldn't say we're in a bubble.
Thanks. Adora?
Maybe one other thing just to think about is volume. I'd say call it 5-10 years ago, there probably weren't 2x the level of ed tech companies and solutions that are touching all aspects of that learning experience, whether it's for parents, for schools and districts, or directly for students. And that volume, coupled with, as Jason is mentioning, capital coming into the space, has just led us to think about way more transactions. There's way more opportunities to transact. And so when we think about a peak, I think about that as, well, followed by a cliff. I'm not convinced that that's coming, because there's just a strong pipeline of potential transactions that could continue to impact our space.
Maybe Adam, what do you think about the next 12 to 18 months for M&A activity in K-12 M&A?
And Adam Klaber, I'm the CEO of Imagine Learning. Imagine Learning, the nation's largest digital curriculum provider. We've done probably 20-odd acquisitions over the past 12 or 13 years. It's slowed down because the markets are questioning what's going on. But I do think it will pick up, and I think pretty dramatically because of the need. When I think about a need, I think about our customers first, and I think about school districts and what they're going through in the United States. And it's a very troubled time for them. And they had the big ramp up, they had funding come in, ramp up of need around digitalization, which in most part they really stepped up and delivered on. They also got a lot of help financially from that from government agencies, and that's not there as much. But now they have a lot of technology, and it's all floating around. And then there's this new thing that hasn't been talked about much in this conference. It's called AI, right?
What is it?
Yeah, we're still trying to, Jason and I were trying to, what does that stand for?
What's it
We're
do?
really not sure. So that's out there. So, you know, it's rational, I think, what's happening now, which is we're thinking about it. We as owners of a business, we think a lot about what we want to do, and we argue with gentlemen like Nate over here around what value is, because it's not so clear as it has been in the past.
Makes sense. One of the key themes that we hear a lot in K-12 is consolidation. Consolidation of vendors, demand by districts and or states for consolidation, and kind of less throats to choke. How do you think that consolidation will impact the M&A market going forward? I don't know, Lester, if you want to start there.
Yeah, sure. So from our perspective, so Lester Liu, I'm SVP of Corporate Development at PowerSchool. And for us, we've been something of a consolidator. We've done about 20 acquisitions in our history. I recently joined the company, and so towards the end of last year, we did 2 acquisitions, and we did another acquisition earlier this year of AlloView. I would say when we look at the pipeline, it looks like there's a healthy pipeline and a lot of interesting opportunities that are coming to market. So we continue to think that there's going to be decent activity in the coming, call it 12 to 48 months. And it's different types of activity, obviously. So some consolidation, some roll-up opportunities. But for us, we're always looking for new growth opportunities, obviously, for incremental TAM. We're a pretty broad platform, so there are segments that are still really interesting to us. So we're thinking about international, maybe doing more in security. Payments is always an interesting area for us. And so we do think there's still a lot of interesting areas for us to continue to look for acquisitions.
And what are your views on consolidation? You guys have been part of it as well. Any views on kind of what are the forces driving that? Adam.
Sorry. Forces driving consolidation. Well, again, I come back to the need, and I think about it very much, and we do from a customer set. And when we think about customers in K-12, who are they, right? At some level, it's students, right? So can you provide a better experience for students, 1. 2 is teachers. There are the critical aspect within the ecosystem of ensuring that the technologies and solutions that we provide really work, and then administrators. So, and I think I compare this to the non-ed space. I came into the ed tech space a little over a decade ago, and what still surprises me about investing capital in this space is how much differentiation there is by our customer set. So if you are in state 1, what your needs are versus state 2, if you're in district 3 versus district 4, and everyone is different. And in fact, it really drives not, I think, healthy behavior from people like us, because we have to spend a lot of time customizing things to meet specific state and district requirements instead of scaling in a more consolidated way and a consistent way. So one of my hopes and from an AI perspective is that we're able to do that faster so that we can keep on plowing back capital into solutions, because as solutions get better, as they become more efficacious, then the investments will be there, the returns will be there for everybody.
Well, how do you think, we've touched on AI already a couple times, and we'll probably dive in a little bit deeper. How is AI affecting your acquisition strategy? Obviously, it's nascent, but it's changing everything that you see, we all see. I don't know, how is it affecting your acquisition strategy? I don't know, Adora, if you want to start.
Yeah, I'm happy to. So, Adora, I work at Curriculum Associates, also recovering banker. So I see both sides a bit when it comes to transactions in the space over the past few years in K-12. We recently bought Soapbox, a voice AI company, late fall. And we were really excited about that. How it's affected our strategy. Well, we take a different approach when it comes to M&A and the thought of consolidation. So you heard from Adam, you heard from Lester. There are platforms in K-12 that are highly active. Our approach is really things that can support our own ecosystem of this integrated experience that deeply supports the classroom from an assessment and instructional perspective. And so from that lens, we really think about the AI enablement tools, things that can help us in our R&D journey, things that we would never be able to build ourselves, that just there are solutions out there that do it better, faster. What's interesting is this evolving ecosystem of almost AI vendors in the space that are solving for content creators like us and Imagine Learning, plenty of other large platforms. And so there's this debate of whether it needs to be in-house or could it be this potential solution as a vendor that can support many other players in a way that's still holding to the fidelity of privacy, security of data, all those things. So for us, it's about, can it solve a product solution that we would never have built ourselves in a way that is that could be integrated into our own platform? And then two, does it do it in a way that's, at least from a cost perspective, reasonable, knowing that all of the needs and the data processing costs around having something that's built around these LLM models is sustainable for us, and what that means going forward.
Yeah, and actually I would say we encourage our companies to think about it similarly. I think we think about it, okay, what is the problem you're trying to solve? So like one example of a really common problem most companies in K-12 who are curriculum facing need to solve right now is a massive political and regulatory challenge, often with respect to what content is presented, alignment with standards, and the scrutiny on this is just like, I think the technical term is bananas. It's like, it's gone, it's just gone berserk. That creates, and Adam mentioned this too, a real like cost problem, because you need to develop separate curriculum for different, for different jurisdictions, states, times, audiences, red states, blue states. I think we all sort of have experienced this when we've spent any time at all around the category. AI isn't going to magically solve that tomorrow, but my gosh, it can help with reducing product development cycles and giving your teams just a giant head start. So that's just one example. So when we look at solving that problem, it's like, okay, what technologies solve that problem? I think what we found at actually many of our companies is that we actually are finding ourselves better equipped to do this in-house using third-party technology and tools that we're bringing in rather than acquiring companies. Because you acquire a company, then you have the issue of all the cultural issues with getting an acquisition done, the due diligence, the deal itself, which can be an actual distraction from just the need to develop technology. So we've generally found, in most cases, we've just sort of ramped up development rather than trying to buy. But I'm sure there'll be situations where there'll be the perfect company that solves the perfect issue, as you all found, and where buying will make sense. That's just one example of a current problem that almost all of our companies and your companies are probably facing that AI can help with, whether acquired or developed.
Makes a ton of sense. We're going to come back to state standards in a minute because I think it's actually a really important topic that probably everybody cares about and everybody here wants to touch on. But I do want to spend one more second on AI. How are you all thinking about evaluating AI acquisitions? Are we back to the dot-com bubble if we're looking at clicks and other things? A lot of these companies are very early, very nascent, but a ton of opportunity in front of them. As you guys are kind of looking at these companies to acquire them, how are you thinking about evaluating them, putting a value on them?
Yeah, I mean, we're taking a two-prong approach. One is we created Imagine Learning Labs, which is really doing venture investments to entrepreneurs who are trying out different things. Because we're very much committed to an open system around AI, and that the technologies become open and that can be used across all of the companies to the advantage of students and teachers and administrators. So that's one. Secondly is we then look at how the company is leveraging AI around efficiencies and effectiveness on those two dimensions. And we're looking at our own development teams in that way. We work in core curriculum, we work in supplemental, intervention, instructional services, and home learning. And in each of our monthly operating reviews, we have each of those general managers kind of walk through what are they doing in this space, how are they thinking about this space, how are they leveraging technology in this space.
Lester, from your standpoint, you guys have a slightly different platform and angle. I'm curious of how you guys are thinking about it.
Yeah, so for us, obviously, we just announced a lot of our internal efforts around this Power Buddy product. And so, really from an acquisition standpoint, I would say it's somewhat secondary given how nascent the sector is. I think I just echo a lot of the comments here where a lot of our activity, frankly, is more focused on internal development. So as far as looking externally, it's more of a partnership-driven approach. I would say as far as looking for acquisition opportunities, it tends to be very, very specific, very small, frankly, opportunities where the impact on our financials will be minimized to a certain extent in terms of profitability. So it's really very specific needs that are going to complement the internal efforts that we're developing ourselves.
Makes sense. Well, why don't we come back to regulatory environment, everybody's favorite topic. Jason, you touched on state standards, evolving challenges that everybody's having to deal with, particularly on the curriculum side. This panel isn't set up to dive deep into that, but you guys are looking at acquisitions, you're looking at investments. It has to be top of mind to your point on AI. How are you thinking about these challenges when you're looking at your next acquisition target?
I have a few. Accessibility. We prioritize increasingly more now than ever before, looking at opportunities that have thought about being accessible by design. The new standards came out in the fall, WCAG 2.2. If you're not familiar with it and you're a builder, familiarize yourself with it. It's going to become increasingly important, but that is just our view and our perspective. Two, it's really important for us to know that there is some level of modularity built within, if it is a digital experience and solution, built within that experience so that if it does get deployed, depending on the state, Jason mentioned red state, blue state, there are a lot of different preferences now and needs from specific states that we're able to be mindful of that, be responsible of those requirements. Three, do we think it's built in a way that we can continue to tweak it to get the product market fit right? And that's both from a usage perspective, but also from the cost to scale. There's some thoughtful approach to it where it doesn't feel like we need a 100-person teacher advisory team reviewing things to tweak the quality of it, that there's some level of the process that's built for that scale up front.
Got it. Helpful. Anyone else have any comments on the regulatory related to the space state specific? Okay. What about the current regulatory environment? Obviously, we're in a political year, ESSER funding, a lot of changes coming from both a regulatory and political standpoint. How are you guys thinking about that potential risk from evaluating M&A for the next 9 months?
I mean, maybe I'll take a cut at it. I mean, when we think about spending and where it's going, if we all had crystal balls, we'd be, I guess, up the road in Las Vegas. But what we do see is that the core curriculum, particularly in English and math, is where now there's a ton of investment, and that the recognition that there's still differentiation that those solutions don't provide, and that they need to be, quote, supplemented with supplemental and intervention solutions. And the more that those can come together, and that they can come together by one provider, so it's one set of logons, it's one set of security and privacy, and one set of professional learning, I think the better. And so that's how we're starting to think about where things are going.
Makes sense. Well, what do we think about M&A versus other options? Obviously, we have people in the audience at different scaling of their company's life cycle, and thinking through whether it's debt, equity, maybe an IPO in the future. M&A is kind of one of those key decision factors. And what would you recommend that somebody thinks through, an executive or a founder, on thinking about M&A versus other options? I don't know, Jason, if you want to kick that one off.
Sure. There's been a lot of empirical research done over time on M&A, especially strategic M&A, and M&A is on average a bad idea. right? Like in general.
But that's a buyer perspective. We're talking about sellers here.
M&A is sort of, value destructive empirically. I think that's actually less true. I saw a recent academic article. It's actually less true now than before, as people are starting to understand sort of the cultural know-how and due diligence around organizations and not just financials. But point still stands, right? Like a lot of acquisitions, they take up a lot of time, they take up a lot of capital, they certainly take they chew up a lot of organizational energy, and they're not as successful as they could or they should be. So when we I don't sit at the operating company level, right? Like I sit at an investment level. So when we look
His
at
hands are very clean, if you notice.
What'd you say?
Your hands are very clean.
Yes, exactly. It's funny.
Sorry to take you off.
So the way we look, we sort of try to analyze the situation. Is this a company we want to own? If the company we want to own, that means it's got a great product, it's got a loyal user base, it does well by its customers, and it has sort of a business model that kind of works, right? And we say, okay, great. Then where's the home for it? And in general, we say, well, do we have a home? Do we have a home already? And when we're looking to see whether we have a home, we say, well, one, does it fit strategically? But then two, are we sure this will help? Like, might they be better off just kind of doing it themselves? And our general bias is if it can be done ourselves, we would prefer to do it ourselves. The reality is, oftentimes, we can't do it faster or better ourselves, and that's when we look to buy. So that's how we would sort of, organize. I'd say philosophically, we have a pretty oppositional approach to buying for the sake of buying down earnings or buying earnings for accretive prices. Not because I have any sort of religious opposition to it, but more that once you've created a big thing with a lot of EBITDA, then what?
Makes sense.
I'd like to add just a point on, I've been fascinated over the years of the number of creative approaches to this question that you're posing to us, Nate, where the number of new entrants in the space that are providing this ability for founders to find patient capital as they continue to prove out their thesis, or as they continue to think about what is the path of sustainability to support this really great idea I have that I hope lasts in the next 10 years. What I've appreciated by this is the number of family offices, the evergreen funds that didn't exist in PE that now exist now, just the channels in which people are providing that level of flexibility, because not only is that appealing to an increasing number of really successful startups or really modernizing organizations in K-12, but that it is almost a necessary part of doing business and supporting in that scale. So I'm encouraged by that. I wonder what the next 10 years looks like and what other creative vehicles will continue to pop up to support the need.
Makes sense.
I mean, isn't patience kind of, it all comes down to patience, right? Patient capital. And I think in this industry where there's so much innovation, I mean, this conference it's always so exciting to come here and you see the innovation and the thinking, and there's so many people passionate about solving these problems. But how do you turn that into amazing companies that have sustainability and that have an ownership structure that they return capital back to shareholders, but most importantly, keep on funneling that capital into more innovation? And I think in this industry, it pays to be patient. In some of the title of the panel, even I'm like, is this a space to make money quickly? And I think the answer is hell no. Now you may time it really right and to do something very quickly, but I know every one of the companies on this panel, and Jason, the ones that you own and sponsor, it's about the long term. right? And with AI coming in, with funding being more questionable, I think it's going to be slower. I think it's going to take a little bit of time, and we're going to be slogging at it and to try to figure out, where things end up. And if you're an owner of a business and you're passionate about the area and you feel really compelled that you have a solution that works, but you're at $8 or $10 million, how do you scale that? And do you go out and raise money in that, or do you become part of an organization like ours to really help catapult its growth? And then from our side is when we think about those investments, do we just put them alone and give them a little capital, which has not been our approach. We have really embedded those businesses into ours. We've consolidated sales forces. We've taken customer success to a whole new level. We built out development and technology teams which share across so that we can then, by doing that, scale to then return back to our investors as well as to keep on funneling for more growth.
Sorry, one last thing, Adam, you made me think of this. When you were emphasizing this point on being patient at varying stages, something that's also pretty unique about K-12 is the growth and the appropriate question at that stage. And so you've seen as you have large platforms that continue to grow, sometimes IPO is part of the exit plan. Mm-hmm. And then as people think about what that next stage of growth, perhaps the take private is the next stage of that growth. And so you've seen this whole arc of large platforms who have gone public, who have come back to this private environment to continue growth, but just in a different way. And so I would encourage those who are thinking about that arc to just know there's the finality of it. There really isn't a level of finality in it. It's an evolution that should be aligned with the growth need of your organization at any moment in time.
Makes sense. Why don't we switch gears a little bit? Obviously, with all the executives in this room here today that are probably thinking about should they sell, or they're ready to sell. Any recommendations that you have for a founder and executive that thinks we may want to sell in the next 6 to 12 months? They should prep for, think about what should be very top of mind. I don't know, Lester, I don't know if you want to start with that one.
Sure. So for us, when we're evaluating a company, it's all about consistency and just demonstrating strong metrics. So it's getting your house in order, obviously, making sure that operations look good. And for us, especially in this type of environment right now, it's really about having good visibility into pipeline. So we do want to be able to make sure that near term, we've got good visibility into what the next year or two is going to look like. And then, obviously, it's about having great product that we think we can integrate properly. So again, it's really down to some of the real basics: strong team, really strong product, and then allowing us to have the visibility that can demonstrate that you're going to be able to continue your performance. And the worst thing you can do from the banking side of things, obviously, is you're going through a process, is to have misses along the way. That's just a bit of a kiss of death. So I just really make sure that your house is in order as you're going into a process to make sure you can have that consistent delivery.
If what it's worth, that's any recommendations other than hiring a banker, because that's an obvious one.
I would almost take a different maybe lens on the question. Everything is obviously that's 100% right. Maybe the first order question is like, what do you want from that investor or that buyer? Like, what are you trying to accomplish? And what sort of investor or company is a realistically good fit for what you do? You don't need to call 50 companies, right, or 50 investors or whatever. Like, it's not that hard, actually, especially in this industry, to find the X number of investors that would be right for you, and then just call around, reference check them, see who else they work with, and then approach them with a pitch. And if you call an investor or a company with a really thoughtful pitch, and you have reasonably good financial metrics, there's some sort of obviously a high bar for performance. But if your performance is generally pretty good and you make a personalized pitch to an investor, we will always listen. That's what we do. It's what we're paid to do.
I couldn't agree more on that last piece, Jason. What I am always surprised by is this power dynamic where it feels as if you're sort of building, or the conversation feels oriented towards the investor or the potential buyer, when oftentimes the gold, the special sauce is really with the organization. And so I would actually encourage people to think more about this. How can this capital serve you and your needs and the importance of scaling the impact that you're already doing? Does this feel aligned with your culture? And have I built a really great business, to Lester's point, have I built a really great business that any investor would be just completely blind to not see? And how do I make sure I hire a great banker to make sure that I'm communicating it across all of the lenses that are critical? I think that's probably my biggest lesson from not only leading a sale process for CA, being on the other side and doing that without a banker, and now buying companies for CA. This idea that actually the power is in all you who are leading these organizations, and you have what you need to make sure that this outcome serves what is going to drive growth in a sustainable way going forward.
Yeah, I think it's really, really important. I would just say it quite succinctly, which is the company has the power. The capital is a commodity. And sometimes in this market with interest rates high, it doesn't feel that way, but like you should always remember the company, the company is the scarce resource. The business is the scarce resource. And approach an investor like that with confidence, with the right pitch in the right way that shows how you're special. And then find the investor who will see how and why you're special, as opposed to trying to guess what the investor might want to see.
And I would just add, and totally agree to all the comments, as a seller, don't try to pretend that everything is working perfectly, because it never is. And if you're trying to pretty it up to be sold, we see that right away.
We're pretty good at figuring that out.
Pretty good at figuring it out. And so it doesn't really make sense. And on the buyer side, the question we ask all the time is, are we the best owner of this business? And why? Are we the best owner? And then to be the best owner, what do we have to do with that?
That's the pitfalls is kind of where you were touching on, but I want to ask the general panelists, any other key pitfalls, right? If you're a year ahead thinking about selling, it's your first time ever doing it, these are all helpful thoughts, but any things that someone should think about avoiding, anything that you've seen companies do that you would recommend that they avoid if they're 6 to 12 months in advance of selling?
Don't get over your skis, as we're saying, right? Don't be spending too much with the hope that, if you build it, they will come. Take your time, prove your value proposition, and be truthful around the way you see things.
Put your business into a lens of AI. What does it look like a few years from now? Will any part of that feel disintermediated or disrupted in any way? And how am I proactively taking steps to guard against that, such that my value proposition still holds true? That's big. And then the second is, at least for us, when it comes to the team that you've built, if you feel like you have a leaky department where there's a lot of attrition, understand why, understand where that is going. Does it feel on par with other functions within our industry or other areas, so that there's clarity on that piece as well? And then a lot of people forget the G&A piece, but make sure that you have a team that's supporting the work out in the field, and that there's a base of people who are able to articulate that when the time is right, with bankers or others to support in the compilation of that story from a financial perspective.
All right, about 6 minutes left, so we'll do a bit of a lightning round through each of the panelists. What are the defining characteristics of your next M&A target? You don't need to be too specific.
A creative? Does a creative work?
Anything specific? Anything that you guys are focused on or looking at in your next M&A target? How about that?
I'll tell you what we're always looking for. So, beloved products. We start with product ultimately. solid technology architecture, so product technology, that's like that element of it. And then on the financials, we're looking for high gross dollar retention rate. So for every dollar that you have year one, like how much of it you retained year two. High gross margin, so for every dollar you make, how much do you have after costs of goods? And on those elements, if it stacks up well, we're going to be interested.
I think I already mentioned some of the broader categories that we're looking at, and we look very, very broadly. I think for us, it's a matter of identifying where there's really going to be, a strong fit. So for us, given that we've got a broad platform, where can we really see this incremental kind of pure play opportunity that minimize some of the overlap with what we may already have? And those types of assets are difficult to find. And I think it gets into some of what we talked about as far as the stage of growth of a company. So we do see a lot of companies and call it this $5 to $10 million range. I think the company is faced with this decision whether or not it continues to develop this fantastic product I have, assuming the product is really strong. I'm at a stage now where I need to build out my sales team. There's a lot of operational investment that now needs to go into growing my company further. So is this the right partner? Can we partner or find an investor who's really going to help accelerate that with us and have that shared vision as we talked about?
I think, and then for us, we think a lot about, is this something that people love? And then there's a lot of different ways to think about that. Usage, NPS, retention metrics. We also think a lot about what is renewals and just the recurring nature of how you've built your solution. Can we aid in any of the go-to-market pieces? And do we think that coupled with how we think about building a great product, we could do that better over time, and it can be a part of our connected ecosystem? Then lastly, culture. That's really big for us. We've said no to opportunities that really make a lot of sense from every of those other boxes because the culture just didn't feel like it fit well on both ends.
And I think this is a good reason why we haven't done a lot of M&A, because we all think the same way, some level. So if you are an entrepreneur out there, have a business, there really is a need from our side, from all of our sides, that a fit within a larger enterprise. I think the only other thing I want to add is services, because districts today and how they evolve their use of curriculum differently, technology differently, the infusion of those three, technology, people, and curriculum is where it's going to be at, and that'll drive all those outcomes that we talked about, stickiness and retention.
That's great. Thanks, everyone. I'll give any final thoughts for our group. Others want to thank our panel and thank everybody in the audience for spending time with us today. Hopefully this was helpful and insightful.